morning and welcome to the August economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm Rob Knapp. I am an External Affairs Associate at the Institute. We're happy to have you with us this morning. So, the title of this briefing is Recession, the Job Market Will Tell Us. And you hear that question mark in the title, and it reflects the question marks we've had in the economy lately. Because on one hand, we've had economic indicators that seem to be pointing toward a recession, either one that was coming or maybe already here. On the other hand, we had a job market, which continued to be strong and post big numbers. So this morning, we have a new report from the Bureau of Labor Statistics on employment, and it's a doozy, but it brings us back to that original question. What is the job market telling us? Our chief economist, Gerald Cohen, is going to be with us in a moment to address that question and give his analysis of where we are, what the employment report means for the economy going forward. That will take up the first part of our program today. For the second part, Dr. Cohen will be answering your questions, which you could submit at any time using the Q&A function at the bottom of the screen. We will try to give priority to press questions. So if you can, please include your name, title, and organization with your submission. If you're joining us by phone today, you can email me your questions. I'm at rob_knapp@kenan-flagler.unc.edu. We are going to try to get to as many questions as we can in the time allotted. We normally close up shop about 9:30 Eastern Time. So with that, it's my pleasure to welcome our chief economist, Gerald Cohen. Gerald, good morning. I hope you and the economy are having a good day.
Thanks, Rob. Yes, the economy is having a very good day. I don't want to discount that there's definitely pain going on, but this data suggests that this is not a recession. In fact, this data is suggesting an acceleration in the economy. The challenge is, and you're kind of already seeing this in markets, is that this puts 75 basis points or 0.75% rate hike back into the kind of view for the Fed. So there was a view that they would, after 2 3/4 point rate increases, they would moderate because the economy was moderating, and move to 0.5 percentage point increase. And I think that this puts the 75 or 0.75% increase back on the table. It's a humdinger of a report. I can't find any signs of weakness except a little bit in the commercial lending market, in the lending market. That's the only weakness, and that's kind of as a result of higher interest rates that we're seeing affecting people who are affecting lowering people's mortgage applications. And so you're seeing that in kind of the commercial bank and actually the non-commercial bank area, so kind of loan brokers and things like that. So let me just start with the data, and then we can go from there. So I'm going to share my screen and hopefully go into presentation mode, and there we go. So what we've been seeing is this dichotomy between strong hiring and weak GDP growth. And this chart just illustrates that. I'm not using hiring. The blue line is the blue line is aggregate hours worked, and that's hiring plus any changes in the work week where you did see a little increase. So this is a really good kind of measure of GDP, because there are two things that go into GDP: the hours worked and productivity. And so, as you can see, it tracks GDP quite nicely, except in this period where you saw 2 quarters of negative growth. So this is year-on-year GDP growth, and you're seeing a slowing. You saw a slowing, or 2 negative quarters of GDP, a slowing in GDP growth, but no signs of slowing in hours worked. And in fact, they accelerated slightly in the month of July. And so year-on-year growth is, relatively flat, suggesting a healthy GDP number. The hours number alone, and we only have July, but if you take that hours number and it suggests 2.5% GDP growth in the third quarter. So this report, and it's, this is our first piece of data for the month of July. I mean, that's kind of hard data for the month of July. This report, or at least, this report suggests that the third quarter is off to a healthy start. And, that if you want to say there was a technical recession of two negative quarters, which I've written that this, I don't believe, I mean, you could say theoretically technical, but I don't think it will be called a recession. And I don't believe it's a recession. This suggests that the economy is growing again in Q3. Now, this is illustrated by the fact that we actually saw an acceleration in job growth. So we had a little bit of slowing. That slowing was to job growth that was exceptional, but you could say it was kind of still part of the post-COVID recovery. To put this in perspective, the job growth that we're seeing is faster than we've seen in the last two recoveries. So the pre-COVID, the recovery from the 2008-2009 great recession, and then that was global financial driven, and then the 2001 recession. During those recoveries, we didn't see job growth this strong. And so we're seeing exceptionally strong job growth. Granted, it's still post-COVID recovery, but as I'll illustrate, we've actually, for the first time, made up. We're past the job. We've surpassed the pre-COVID levels now by 32,000. So this report now puts us above pre-COVID levels in terms of job creation. So we are a number of employment in the economy. So let me just stress one thing about the previous chart. Not only did we see this healthy jobs number of 528,000, but previous months were revised up. Again, if we were going into recession, if the economy were slowing, you would see the revisions to be downward. And the consensus was that you were going to see a slowdown in job creation, 250,000, when in fact we got an acceleration. So you have two things that are anti-recessionary. One is the pickup in job growth, 528,000. I just can't stress how strong that is. And then with that, upward revisions. And so if you include the revisions and the job creation, the job numbers were over 300,000 above what the consensus expected the level of jobs to be. So we beat expectations by 250 plus thousand, or 200, and then 278,000. And then we had positive job growth, positive revision. So that's kind of 300,000 over where economists expected the market to be. So as I said, we've exceeded the pre-COVID peak. The unemployment rate ticked down to 3.5%. It now matches the 50-year low of 3.5% that we got to at pre-COVID. And this was on the back again of decent employment, declines in the number of unemployed from this measure. And wait, I'm sorry, this is my screen's keep switching. So declines in the number of people that are unemployed, increases in the number of employment. There are two different measures of the economy that are being released. One is the number of people employed through payrolls, through their jobs, and then there's a survey of households, and this report comes from the survey of households. So both measures are pointing to the same thing: continued healthy job growth. The broadest measure of unemployment, which includes people who are working part-time for economic reasons and people who would like a job, but are saying they're not officially looking for a job, but they would accept one if somebody came to them and gave an offer, stayed at its record low levels. And this data goes back to 1994. The jobs data goes back, a lot longer, the full unemployment rate. Kind of a mixed picture on the participation rate. What you did actually see is the labor force declined slightly. And we saw this, and that this kind of tells a tale of two parts of the economy. One is that the overall labor force participation rate ticked down, but prime age, which is 25 to 54-year-olds, which are kind of the largest share of participation, but because of demographic changes is becoming smaller. But this is the measure of kind of people who are, in their key working age. That participation rate ticked up. And as you can see in the orange line, we're getting close to pre-COVID levels, but we're still below it. And this is the challenge for the Fed, that they want the labor market to slow. They don't want a lot of wage inflation. They want things to be slowing. And a good way to slow, kind of benign, soft landing way to slow, is to increase the working age population, which is through, the only way to do that in the short term is through immigration, or to increase the labor force participation. And that gets you your soft landing. So this is kind of giving a mixed picture on the possibility of a soft landing, or you're going to get a recession. So what you would want to see, if you want to see that soft landing in the labor market, is a pickup in labor force participation to meet the job growth that's happening, or meet the demand. And you're seeing a little, mixed evidence on that. Let's put it that way. People who are in their prime age are more people are joining the labor force. People who overall, though, are not, and 55 and older, teenagers, things like that. Turning to wages, and I guess this is really important for the Fed, is you saw a little pickup in wage growth, or in the month-on-month wage growth, in average, that's known as average hourly earnings. That's the blue line. Sorry, I'm having some screen issues. But that growth is lower than inflation. So real or inflation adjusted wages continue to shrink. And this is the challenge for workers, because workers want higher wages. But the challenge for the Fed is, if you get everybody wanting higher wages, then that pushes through to inflation, and then they have to tighten even more. So this report, again, is suggestive that the Fed is going to have to keep tightening, that the economy remains strong, because, in a weak economy, people would not be looking for wage gain, or not have the ability to ask for wage gains. If the economy was weak, people would be saying, look, I just happy to hold on to my job. But, when you're creating 528,000 jobs, and there are significant job openings, as we saw on Wednesday, although it slowed, it's still very strong. People have the ability to say, look, give me wage increases, or I'll take another job. I'll go find a job that will give me wage increases. And this is the challenge. It's great for the economy, great for spending power, although again, it's less than inflation, but you're not seeing that. But it's putting upward pressure on inflation, and that's the challenge for the Fed. I was expecting to talk about, the forward-looking indicators to tell us whether we were in a recession or not. But again, the data was so strong. I do want to point out something. Temp help, which is a really nice forward-looking indicator, had a pickup in the number of temp help jobs increased by 10,000. That doesn't seem like a big number, but these gains are relatively small. But it's kind of flat to up, suggesting, again, a healthy job market. Part of the challenge with temp help is that, given the labor worker shortage, it's hard to know if temp help companies are just having a hard time finding people, or are they is demand slowing for temp help services. So it's hard to know how to read this. In the past, you'd say decent temp help numbers, decent job growth, and if this rolled over, that would suggest a slowing, but you're just not seeing it. This suggests some moderation in job creation going forward, but again, healthy numbers. And lastly, another thing that we're watching closely, and it did not tell us anything, is jobless claims. They've been ticking up, suggesting slowing but continued healthy job growth. That's not what we got. But remember, the jobs unemployment number, the jobless claims are only half of the picture. That's you're seeing people who have been fired, or only a quarter of the picture. You're seeing people who have been fired, not people who have been hired or people who have quit their jobs because they decide to do something else, or decide or to take another job. So this is it's an imperfect picture, but it's a very high frequency one because we get this on a weekly basis. So let me stop there and open it up to questions.
Thank you very much, Gerald. It's been a busy morning for you.
Yes.
So we, as always, appreciate the quick take analysis, which was especially quick take this morning with some big news coming out. All right, so it is question time, and let me remind you, if you do have questions, now's the time. Please use the Q&A function at the bottom of the screen to submit them. Please include your name, title, and organization with them. Also, if you're joining us by phone, please email your questions to me. I'm at rob_knapp@Kenan-Flagler.unc.edu. Okay, our first question is from Matt Boyle at Bloomberg News. Matt asked, recent news of layoffs and hiring freezes in some sectors suggested that the balance of power in the hiring market was shifting back a bit from employees who had been in the driver's seat to employers. But what do today's job wage numbers say about that balance?
So thanks for the question, Matt. I think that this number suggests that it's shifting back towards labor. The fact that it's hard to read, just one number. One of the reasons why I take the 3-month average of job numbers is because there is month-to-month volatility. But that 3-month average, as I illustrated on the second chart, has accelerated. So it suggests that the labor is in the driver's seat. The slowdown that we saw in job openings on Wednesday suggests that maybe that a driver's seat is a little there's some room in it because firms are maybe not. Maybe fewer firms are looking to hire, but that number is still super high relative to history. So I just want to stress that the number of job openings remains very strong, and despite the fact that we've exceeded the previous peak in employment by 32,000, courtesy of this number and the upward revisions from the previous 2 months. There are still pockets, and one in particular is leisure and hospitality, where there are over 1 million, I think it's actually close to 1.2 million fewer jobs than we saw in the past. So there are areas where, it's and this is one of the challenges, is that the picture can be very mixed. So as I said, this is not at the start, this does not look like a recession, but clearly there's still people that are hurting. And there are areas where there are shortages, continue to be strong labor shortages, like leisure and hospitality, but other areas where, that we well exceeded previous job previous job levels, and one of the areas is in the tech area, and you're seeing layoffs in some places, but we did not see that on a national level, at least in the overall information and technology sector. I didn't get into it's hard to see where, the Googles and the Amazons are, or Meta, where you're seeing announcements of layoffs. It's hard to see specifically point to that area, but you saw job growth in that area. But in those sectors, the firms might have the upper hand. In areas like leisure and hospitality, workers probably continue to have the upper hand. But this report suggests that overall on a national level, workers are still in the driver's seat.
Okay, thanks very much. Next question is from Laura Leslie, Capital Bureau Chief at WRAL. She asks, how much of the labor force shortage might be due to people moving out of full-time jobs into gig employment or self-employment?
So Laura, thanks for the question. So in theory, gig employment is captured in these numbers, and in particular, and this is the unemployment and labor force participation. Those flows that you're kind of asking about come from the household survey, where you ask where the government goes and surveys 60,000 households. Do you have a job? And those numbers should be captured in those shifts should be captured in between traditional employers versus gig employers. Those numbers should be captured. I'd need to look into the data to see if I could kind of tease that out, and I didn't in the half hour that I was in the half hour that I had. I didn't get a chance to look at that. But it's an interesting question. There is a challenge because as the economy shifts, it's maybe harder to see those jobs in the survey of employers. So when you go and you ask, the Bureau of Labor Statistics will ask UNC, how many people do you have on your payroll? Or they'll ask Uber, how many people you have on your payroll? Those numbers are, if people are moving and creating consultancy, those numbers, they don't see that. They don't know that consultancy has been created until they get the tax data, and then they can get a sense of that. So it's hard to see in that survey, but it should be captured in the survey of households. So I realize that that's more of an answer of the technical aspects, but this data overall suggests that household employment continues to be strong, although it was not as strong as the payroll numbers. But that month to month, there's a lot of volatility and differences, and we tend to look more at the payroll numbers, the survey of employers, for the number of employees that are out there.
Okay, very good. Thank you. Next question is from Lauren O at the Triangle Business Journal. Lauren, I'm going to reach out to you and learn how to pronounce your last name correctly so that I don't massacre it this time, and I'll get it right next time. Lauren asks, what do you think this means for North Carolina businesses? So
North Carolina, I think is I've been asked about this, and thinking about this question, that there are substantial differences. So the country is not a monolithic economy. So there can be pockets of strength and weaknesses. Even in the midst of the strongest recovery or strongest expansion, there are areas that are experiencing weakness. And the same is true in the opposite case. Even during recessions, you could have areas of strength. The Triangle area is an area where you're seeing a lot of job creation, a lot of people moving into the area. So even if what I've been saying is, even if there is a recession, and this data again does not suggest that's the case, I think it could be that the Triangle area would not necessarily have declining growth. It would likely slow. This data just says that the Triangle economy suggests that the Triangle economy will remain supercharged. I also want to note that we are going to be releasing some data with next month's employment report. My colleague Greg Brown will be illustrating some research we've been doing on regional differences in economic activity. So we're creating, the name is not yet official, but we don't know exactly what our official, we're calling it, but our beta version is the Regional Economic Indicators. REI has already taken. So I think we're not going to infringe on their trademark. But tune in next month and we'll actually be able to say something about regional differences in the economy. But what I can tell you from doing the underlying, what we have so far is that they are significant, and that the triangle continues or has been growing meaningfully faster than other parts of the economy, but not and that there are large differences. It's not the fastest growing area, but it is one of the faster growing areas.
Okay, very good. We've got 3 questions left. Maybe we can go ahead and try and squeeze all 3 of those in the time we have remaining. Here's one from Katie Gales, who asks, as you probably know, about 90% of all enterprises in the US are small businesses. Many are very small businesses or solo entrepreneurs. What is the forecasted economic impact on these businesses?
So I mean, as you said, that they're very large, or small businesses are a very large share of the economy, and it's unfortunate because it's very hard to know exactly what's going on because there's relatively, many of them are relatively small, like sole proprietors, single worker, or 1 or 2 people, mom and pop shops. It's hard to make generalizations about what's going on in the small business sector. And interestingly, despite, we have this wealth of data, and this is something where, big data will help us, we don't really have a great handle on what's going on in small businesses. The Bureau of Labor Statistics surveys them, but, it's hard to survey all the small businesses. So I unfortunately, and there's some data, but it's lagged, that we can say about small business growth, and it's been growing quite strongly. But this report actually doesn't break down by business size. It'll take, we know a bit about what's going on in June, and that continues that says that small businesses continue to grow. But and I would say that this data suggests that you've seen some acceleration in small business employment, but again, it's hard to say too much about that specific area. It's just, even though it's so large, it's hard to measure just because it's so diverse.
Right. Okay. Could you talk more about wage growth? This is from Meredith Miller.
Yes. So wage growth, you actually, as I mentioned, we saw some acceleration in wage growth. It grew 0.5% in the month of July, after gains of 0.4 in the previous 2 months. And this is suggesting, that as I said in previous question, that labor has been in the driver's seat, that they can ask for wage gains because there's strong demand for labor. One of the challenges with this particular number is that we're looking at overall wages, and in the month of July, there's hiring of students, and those tend to be lower wage jobs, and so this mix is a little complicated. But despite the fact that you might have a little downward pressure on wages from just the hiring of summer employees, lifeguards, we had this acceleration, which suggests that, again, wage growth is quite strong, and that labor can go and ask for wage increases. And as my colleague Camille, Dr. Kenan has talked about that the best way to actually get wage gains is by switching jobs. So the fact that you're seeing this kind of job creation or job movement suggests that people are moving to different jobs to get wage gains.
Okay, thanks. Last one. Let's call this a lightning round question. This is from Lisa Finaldi at NC Early Childhood Foundation. She asks, are there specific demographics of people that could be an important part of relieving the workforce shortage? That is, baby boomers, women, et cetera.
That's a great question, Lisa. And yes, the answer is that we need people who, labor force participation rate of women has increased substantially since since the 70s, but it's still well below men. And that there are policies such as childcare, and that can increase that labor force participation. So I'm not saying that because I'm speaking to the audience. I'm saying that based on research that we've done at the Kenan Institute to this very effect. We wrote a piece about this, and so Rob can share it with you. So policies that are favorable to women, or policies such as childcare, can increase the labor force, and that's a way of getting this soft landing that I mentioned. If you can increase the labor force, the other one, as you said, is baby boomers. So, because of one of the reasons why in that chart that I showed that labor force participation rate has been declining on an overall level is because of shifts in demographics. We just have fewer prime age workers and more 55 and over, and they have much lower participation. And you see it declines at 55, and then it declines. You could see it every year. Participation rate declines. So getting those folks back into the labor market can also relieve these shortages. So this is definitely a solution, and I think the Fed is really hoping for that to keep them from. They'd much rather have people entering the labor force than having to raise rates. If you had 3 million people enter the labor force tomorrow, I think the Fed would say, okay, if they knew that, they would say, look, there's enough labor out there. I think probably, if we convince people that inflation is on the decline, I'm not saying they would stop, but I think they would definitely take this, 75 basis points off the table, and they probably would stop a lot sooner. So that's the very positive, benign way of getting a loosening of the labor market.
And the Fed would love to have an easy choice to make at this point, I'm sure.
Yeah, exactly, Rob. Exactly.
All right. Well, we've reached time. We're actually a tiny bit past. This is fun. Let's do this again sometime. But before we talk about this, thank you very much to our chief economist, Gerald Cohen, for his great analysis, as always. Thank you to everybody out there for your questions, strong as always, and we were actually able to get to all of them this time, which was good as well. So I'd like to continue the conversation with anyone who wants to. If anyone out there is interested in talking to Dr. Cohen or to any of our other experts, you can email me at rob_knapp@Kenan-Flagler.unc.edu. We'd also be happy to support your coverage in other areas of business and economic issues. We invite you to learn more about us by checking out our webpage at Kenan-Institute.unc.edu. So, mark September 2nd on your calendar. Another Bureau of Labor Statistics report will be coming out, and we'll be having another economic briefing. Be sure to check us out before you leave on Labor Day vacation, or maybe take a vacation. I think we could probably all use a vacation after this morning. Till then, thanks very much for joining us, and have a great Friday.